In this free video course, you will learn everything you need to know about smart money concepts for trading crypto, stocks, forex, or any other financial market. By the end of the course, you won't just know how to trade smart money concepts to make money, but you will also learn multiple powerful SMC techniques that most traders have never even heard about. Alright, so hello guys and welcome to this full smart money concepts trading course. And as you guys have seen on the title, this right here is the course that I wish I had years ago. This course could have saved me both time and money, and that is basically my overall goal with this course. I want to break down smart money concepts in a clear and simple step-by-step manner, and I want to do it completely for free. But now, before we start here, I do want to mention a few important things, and the first thing I do want to mention is that I have built this course in a step-by-step manner from beginner to advanced. So I do highly recommend to watch this course in order. So start from the beginning and watch it all the way through to the end. But if you for some reason don't want to watch the full course, perhaps you are certain that you know about specific parts, don't worry, because I will have video chapters so you can jump through the video to a specific part. But as I said, I actually don't recommend that you do that. I do recommend that you watch it in order, because even on the more simple concepts, you might learn something new and there might be important stuff in there that you currently don't know about. So please, make sure to, at least if you have the time, watch through the course in order. The other thing I want to mention before we start here is that I will be using TradingView quite a lot for this course. TradingView is the technical analysis platform I have been using for 5+ years, and it's a really solid platform. And the good thing is that TradingView is available for free, and you will be able to do most things I do in this video for free. But if you want to be able to follow along and do exactly what I do throughout this course, you will need TradingView Premium. But don't worry, because I do have a special link. The link will be both in the description and the pinned comment. And you can use that link to try TradingView Premium for free for 30 days. So you can follow along in this course. And then if you later on decide that you want to continue with TradingView Premium, you will get a $15 bonus. And now, before we can start taking a look at our smart money concepts, we of course first need to understand what is smart money in the first place. And well, smart money basically refers to large professional investors such as institutions, hedge funds, and banks. So these are basically traders and investors that have access to lots of money, much more money than me and you. So what is common among these players is that they usually have access to, better tools, better data, and also more capital than us retail traders. Retail traders are basically the small traders like me and you, right? And here, and this is very important, they, or in other words, smart money, often influence price by creating liquidity. Don't worry, you will learn about liquidity in this course. And they also manipulate important levels in the market. And you might wonder, what do we mean by manipulation? This is a word that gets thrown around a lot, when it comes to trading. I'm not really a big fan of the word manipulating, but we definitely have to use it, because what this basically means is that when you have lots and lots of money, like smart money has, you have a much bigger influence on the price itself. So when you have lots of money and perhaps you are trading something with not too much liquidity, you yourself can actually influence the price. And many smart money traders actually use their large capital to sort of steal money from retail traders. And we will go very deep into the concepts in this video. But here, smart money concepts or basically a trading approach that focuses on identifying and, even more importantly, following the behavior of the big players. So think about it. If we can learn how smart money trades, in which direction, what patterns are they looking out for, what concepts are they using, right? That is where smart money concepts comes from. If we can identify these things and trade in the same direction as smart money, then we can actually take advantage of the sort of manipulation that smart money uses. And that is what smart money concepts is all about. So yeah, guys, I hope this sounds interesting, and make sure to lock in, because now we are diving into the first concept. All right, so the very first thing we need to learn here is the basics of trend and market structure, because these simple concepts are the foundation for the other concepts. So you really need to understand basic trend in order to use the other concepts. So let's just begin here by taking a look at the different kinds of trend states, and then I will show you guys some important things about them. But first of all, we do have the uptrend. This is the first trend state, and this is simply when price is moving higher over time. This is the basic definition. In an uptrend, and this is very important, you will see both higher highs and higher lows. Don't worry, I will show you guys this visually very soon. And an uptrend suggests that buyers are in control over the market. Or in other words, the momentum is bullish in the long term. Later on in this course, we will take a very close look at momentum and why momentum is so important. But for now, this is all you need to know. And when it comes to the next trend state, we of course also have the downtrend. The downtrend is the exact opposite of the uptrend. This is when price is moving lower over time, and we see both lower highs and lower lows forming. And this shows that now the sellers are the dominant force in the market, and the sort of overall momentum is bearish. The third trend state I want to cover right now is the sideways market, or in other words, the trading range. And this is when the price moves within a horizontal zone between support and resistance. And the market in this kind of state shows no clear direction. And this is often a consolidation phase before a large move begins. And don't worry, you will learn about consolidation later on. But what I already can mention about sideways markets is that a common misconception is that sideways markets are always, strictly in between a perfect resistance and support level, but you will very soon learn why this is not the case. But right, so now let's take a look at some important things you need to know about the uptrend, downtrend, and sideways market. And first of all, remember that in order to have an uptrend, we need to print both higher highs and higher lows. So for example, right here, you can see that we have one high right here, and here we have a higher high. So we usually mark this with an H for high, and we mark the higher high with HH. Right here, we have a low, we can mark it with L. And right here, right, we have a higher low. We can mark this with HL. And as long as this trend continues to print higher highs and higher lows, we are in an uptrend. So this is the very simple definition of an uptrend. And the opposite is true for the downtrend. So as long as we're printing lower highs and lower lows, we are in a downtrend, right? So here, once again, we have a high, we can mark it with H, and here we have a lower high, right? So high, lower high, we have a low, and here we have a lower low. And as long as we're continuing to print lower highs and lower lows, we have a downtrend. But now I do want to show you guys the third state, and let me actually delete the uptrend and downtrend for now, because now I want to show you guys the sideways market. So the sideways market, or another word for this, remember, is trading range. And Here, the sideways markets can actually be a little bit more complicated than the uptrend and the downtrend. Because many people, when they think about sideways market, they think about a market that simply has the lows and the highs at the same level. So in this example, you can see here that we have lows at the exact same level, and we have highs at pretty much the same level as well. But one thing that is important to notice about these sideways markets is that we actually have multiple versions of sideways markets. All markets that are not uptrends or downtrends are some kinds of sideways markets. So for example, you could have a market where you have a high, a low, then a higher high, and then a lower low, and then a higher high again, a lower low again. So this right here is neither an uptrend or a downtrend. This right here is actually a sideways market, but it's not one of the most common markets, and it's not a kind of market that you think about when you think about a sideways market. This structure right here is actually known as a broadening structure. But we could also have a market that looks, more like a sort of triangle, right? We can have a market that looks like this. It prints lower highs, right? And higher lows at the same time. This right here is a triangle looking structure, and this is what is known as a chart pattern. By the way, if you want to learn more about chart patterns, I do have a full chart pattern trading course, and I will make sure to link it up in the video card and the description. But don't watch that course yet, because this current course is just getting started. All right, so now I just want to test you guys with some advanced questions, or just one advanced concept here. So from what you have just recently learned, what would you say that this kind of market is? This looks super, super weird, but this market right here, is this an uptrend, downtrend, or a sideways market? Well, here you can see that this price is clearly printing one high, a higher high, and then yet another higher high. But with the lows here, we're having lows at the exact same level. So in this case, we actually don't have an uptrend, and we also don't have a downtrend. So this right here is yet another form of sideways market. However, if these lows were just a little bit higher, so let's say that we had, a market that maybe looks something like it, this. In this case, we actually do have an uptrend, because we are printing slightly higher lows and higher highs. But right, so now it's time to switch the attention to some very important market structure concepts in smart money trading. And the first concept we need to learn about is something called break of structure, or for short, BOS. And what is a break of structure? Well, a break of structure happens when price moves above a previous high or below a previous low. So it can happen in both uptrends and downtrends. And what a break of structure does is that it confirms that the current trend is continuing. So this is a very important sort of continuation signal when it comes to market structure. So for example, in an uptrend, a break above the recent swing high, the recent swing high, don't worry, you will learn about that very soon, confirms the bullish strength. But here we also have another important concept, and that is change of character, or for short, CHOCH. And it should be a capital H right here. You usually write it like that. And here, a change of character signals a possible shift in trend direction, or in other words, a potential reversal. And the change of character happens when price breaks structure in the opposite direction of the previous trend. And this is so much easier to show you guys visually, so I will show you guys very soon. But here, for example, if an uptrend breaks below a recent swing low, it may indicate the beginning of a bearish trend instead. But it doesn't mean that we flip to a bearish trend right away. It could mean a flip from an uptrend to a sideways market, or from an uptrend to a downtrend. But all right, so now to understand break of structure and change of character, let me actually once again draw out a trend. So remember, in order to have an uptrend, we need to print both higher highs and higher lows. So right here, we have a beautiful uptrend. And let's actually begin here with the most simple concept, and that is the break of structure. So what is a break of structure? Well, remember that a break of structure occurs when we break to a new high in an uptrend or break to a new low in a downtrend. So because we are in an uptrend right here, the break of structure will actually occur when we break to a new high in the uptrend. So this right here is actually a break of structure. To make it a bit more clear, let's actually write in green right here. So this right here is our first break of structure because it breaks to a new high. And the reason we draw it at this point right here, because this is the exact point when the price pushes above the previous high, right? This right here was the previous high in the uptrend. So let me actually mark up the highs right here so you can clearly see. Now, when you know this, you might be able to find the next break of structure. So where is the next point when we break to an even new high? Well, once we pass this point right here, we have another break of structure because this is the point where we break above a new high again. Once again, at this point right here, the price pushes above the new high. So here we have yet another break of structure. But now you might, of course, wonder what happens if this downtrend, doesn't continue. So let's say that we once again start to fall down. Maybe we get a little bounce here, but this bounce fails to break this point right here. We fail to break structure, and instead we fall like this. Now we actually have the other type of break, because when we break, let me actually use another color. When we break this low right here, we actually have a change of character. And why is this a change of character? Well, when we break the swing low in a trend, so let me mark up the lows here. We have one low right here, we have the next low right here, and the next low right here. It is when we break that exact point, we get our change of character. One thing you might ask yourself now is, what about, let me mark this with purple, what about this low? Well, this low is not really relevant because this low didn't do anything. It didn't break the significant low in the uptrend, and this high right here didn't push above the important level right here that we need in order to continue the uptrend. So these two levels are what we call sort of internal levels. They might be important if we zoom into a shorter term time frame, but they are not relevant right here. But right, so now then, the next important concept I want to cover is something called strong versus weak highs and lows. And if you understand break of structure and change of character, this concept will be much more simple to grasp and you will hopefully learn it really quickly. But first of all, what is a strong low? Well, in simple terms, a strong low is followed by a move that breaks above the previous high. So if we have a move that breaks, that causes a break of structure, then we have a strong low. The same thing, but the opposite is true for the strong high. A strong high is followed by a move that breaks below the previous swing low. And in both of these cases, it shows clear strength and it makes the levels more likely to act as either support or resistance in the future. And here, two more important concepts is weak lows and weak highs. And a weak low is a low that fails to break any previous high after bouncing. And this suggests weak buying. And what is a weak high? Well, a weak high fails to break any previous low after a pullback. And this shows weak selling. But here, once again, I think this will be much more clear when I show you visually. But all right, so now let's take a look at strong/weak, highs/lows. And let's draw out a similar market to when we took a look at the break of structure and change of character. So we might have a market that looks something like this, right? Then we had a move maybe like this. So first we had an uptrend, then we had a sort of break. But here, let's begin here with the strong lows. And first, let me actually mark up the strong lows and let me see if you guys can find a pattern right here. So this right here is a strong low and this right here is a strong low, while this right here is a weak low. And can you find any kind of pattern between these lows? What is similar between the blue lows and what is different about the purple low? Well, the difference here is that the strong lows are causing break of structures, right? The strong low caused a break of structure right here. The strong low caused a break of structure right here. But this weak low, this right here is a weak low. It did not break the structure, right? So this right here is strong. This low right here is strong. But now what about the highs? Well, this high and this high is very similar. However, the high that is different, very different, is this yellow high right here. So what is the difference here? Well, if we take a close look, we can see that the first one is weak because this point right here failed to break any, important structure. This one is also weak because the move that comes from that high didn't break anything significant. However, this one right here is strong. Why is this one strong? Well, because this is the move that, was the beginning of the push that pushed below the strong low right here. Right, so now the time has finally come to take a look at the fair value gaps, or for short, FVGs. This right here is a very popular smart money concept, but in my opinion, I feel like many traders are overcomplicated fair value gaps. So hopefully it will be super clear after this. But before we take a look at the fair value gaps visually, let's just talk about what they are. A fair value gap is basically a small price zone on the chart where the market moved so quickly that trading activity was thin, or also known as inefficient. And a fair value gap forms when there is little overlap between, 3 consecutive candles, and it often forms during a strong impulsive move. This right here is yet another concept you will learn more about soon. But here, these gaps can act as potential support and resistance areas, or even supply and demand areas in the future. And price often returns to these levels, and they can work as zones where you can find entries. So now, in order to find fair value gaps, the easiest way to do this is to look at 3 candles. So let's say that we have 3 candlesticks right here. Right here is the first candle. Then we have like a strong momentum candle right here, and the next candle might look something like this. And here, as I said, many traders are overcomplicating fair value gaps so much. What a fair value gap simply is, it is the area here in between the highest point of candle 1 and the lowest point of the wick of candle 3. So we have candle 1, 2, 3, and the fair value gap is simply the area here in between. This right here is the fair value gap. And since the price is going up in this case, this right here is a bullish fair value gap. So I forgot to, draw it out, but these candles are green right here. So I'm sorry, the drawings are getting super ugly right now, but I hope you understand. This right here is a bullish fair value gap. But the opposite is of course true for the bearish fair value gap. So let's try to draw out a nice bearish fair value gap here. So once again, we look at 3 candles. Let's say that the first candle looks like this. Maybe the next candle is once again a very strong candle. Remember here that fair value gaps often comes when we have one candle should be, a strong momentum candle. What I'm usually looking out for is that I want this candle to be at the very least twice the size of the previous candles, but preferably maybe 3 times, up to 5 times or even more than the previous candles. But we're looking out for the middle candle should be strong, and then we have a third candle right here. And to make it a bit harder, let's actually say that this wick was down all the way down here. So now in this case, where is the fair value gap? Well, once again, the gap here is where the difference in this case between the lowest point of candle 1 and the highest point of candle 3. So in this case, we have a very, very small fair value gap. But you can notice here that in these gaps, we only have a part of the second candle. So this is where the sort of imbalance comes from, that this price area was only, we only had price action in this area for a very brief amount of time. And this is where the sort of imbalance comes from. And what many traders use is that they then wait for the price to sometime in the future come back and test this level. Then they look out for some sort of price action signal, and they can use this as an entry model. But don't worry, we will talk more about that later on in this course. But for now, this is all you need to know about fair value gaps. So what exactly is liquidity in trading? And how do we identify and trade liquidity grabs and liquidity sweeps, step by step, to make money? Well, the very first thing we need to do before we can start trading our liquidity grabs and liquidity sweeps is to answer the very important question, what is liquidity in trading? And here, I think that liquidity is a concept that many educators sort of make too complicated. Because in very simple terms, liquidity basically refers to how easily an asset can be bought or sold without causing a big change in price. And when I talk about asset, this can be anything from, stocks, cryptocurrencies, forex pairs, and so on and so on. And something that is high liquidity is something that you can sell right away. It's easy to sell and you won't really affect the market. Think of things like, for example, Bitcoin or a large stock or a common forex pair. You can easily buy and sell that. So in simple terms, it's a measure of how quickly you can convert your investment to cash at a fair price. So you can basically think of liquidity as the crowdedness of the market. The more buyers and sellers we have, the more liquidity. But now then, why does liquidity matter? Why is liquidity so important to understand as traders? Well, the first thing about liquidity is that it leads to a tight bid-ask spread. So in highly liquid markets, the difference between the buying and selling side is small, which leads to cheaper trades, right? It will be cheaper to trade in highly liquid market. Another very key thing is low slippage. So you can enter and exit larger positions without moving the price. So for example, if some of you guys watching are very large traders, you know that if you are trading a small stock or small, for example, altcoin, you yourself can actually move the price a lot. And that is something we preferably want to avoid. Another very nice things about liquid markets is market stability. So high liquid markets tend to be less volatile, and volatility here is a very, very important concept to understand. And I actually have a video about volatility, so I highly recommend checking out that video after this one just to get a deeper understanding of volatility. But they tend to be less volatile and more resistant to manipulation by large players, or in other words, smart money. I do have many videos on smart money trading as well, so I highly recommend to check out these courses after this video. Last but not least, it's easy to enter and exit liquid markets. But alright, so now let's take a quick look at some high versus low liquidity markets. So some examples of high liquid markets, or in other words, markets that we can easily get in and out without moving the price, are, for example, major forex pairs, like Euro USD, large stocks like Apple, Amazon, Nvidia, and so on and so on. And we can even talk about markets like US Treasury bonds. While low liquidity markets, as I already mentioned, are, for example, penny stocks, very small altcoins, small cryptocurrencies, and also tinely traded commodities. But alright, so now it's finally time to talk about why I think many of you guys are even watching this video in the first place, and that is liquidity grabs and liquidity sweeps. What are they and how can we trade them step by step? Well, liquidity grabs and sweeps are strategies used by large players to find sort of counterparties for their trades. Or in other words, these moves target areas where we have many stop loss orders. This is very important, and you will understand that very soon. But first, we need to understand that there's a slight difference here between liquidity grab and liquidity sweep. Some traders will use them in the same way, that they mean exactly the same way, but there are a bit of nuance here. So let's first take a look at the liquidity grab. A liquidity grab is a quick, targeted move where the price briefly breaks a level or pierces a level with a lot of orders and then snaps back. So what we're looking out for here is, first of all, brief duration. So it's usually just one candlestick and usually just a wick above a support or resistance level. As you can see here, it shows up as a long wick on the chart, and price immediately reverses direction. It often also looks like or is called a fake out. So very soon we will take a look at an example of how to trade the liquidity grab step by step, where to set your profit target, where to set your stop loss, and so on and so on. But first, we need to also take a look at the liquidity sweep. So in general, this is a sort of broader push through a liquidity zone or a larger sort of supply and demand area. Sometimes the liquidity sweep can actually last multiple candles before eventually reversing. So in general, liquidity sweeps tend to be longer duration. They tend to also push further beyond the level, and the reversal can be more gradual. So liquidity grabs tend to be more spiky. Liquidity sweeps can be a bit more gradual, but it should still go pretty fast. And one sort of dangerous thing about the liquidity sweep is that it can trap many traders. But here, and this is very important, we as small traders can actually use liquidity grabs and liquidity sweeps to try to trade in the same direction as smart money. And here, as for the common targets, I do think this is much easier to just show on the chart instead of, using text. So now, guys, let's jump into TradingView. Alright, guys, so now we are in TradingView. By the way, if you, for some reason, don't use TradingView yet, I have a special link to TradingView. You can use that link to try out the best version of TradingView for 30 days for free. And if you eventually decide to want to upgrade your plan, you will get a $15 bonus. But now let's take a look at how to trade the liquidity grab step by step. So first of all, right now we're looking at the Bitcoin, we're looking at the BTC on the 30-minute time frame. But you can find liquidity grabs and liquidity sweeps on pretty much all time frames. And the first thing I want you to notice about this chart is that we have a very clear resistance level right here. You can see that the price got reacted not only one time, 2 times, 3 times, 4 times here. So we have multiple reactions as resistance right here. And when we have such a clear resistance level, what many traders usually do, imagine traders that are going short here, that bet that the price will go down, they usually tend to place their stop losses either at the resistance, so somewhere around here, or just above the resistance. And this is actually very important because this is what the smart players will use when they perform their liquidity grab. So what smart money do here is that they push the price up into these stop losses. And what happens when the stop losses of short players trigger? Well, the short players have to buy back, which leads to the price going even higher. And as we can see, this is exactly what happened with this wick right here. Now, when the smart players successfully have pushed the price up, they can actually sell, which leads to this quick wick here to the downside. The smart money makes a profit, while retail traders like me and you get liquidated, and we get stopped out of the market with a loss. But how can we as traders actually trade and use this principle ourselves? Well, one of the best strategies and one of the most simple method to trade the liquidity grabs is to enter at the candle close just below the liquidity zone, or in other words, just below the resistance zone right here, where we had all the stop losses above. And as for the stop loss, the by far easiest and also a great place to set your stop loss, I hope you can see here, is to set it just above the wick, the highest point of the wick when it comes to when we are shorting, and the lowest point of the wick when we go long. So we set the stop loss just above right here, and using a simple 2-to-1 risk to reward, which means that the green area here is twice as long as the red area, would have your target right here. And as you can see, this trade played out perfectly. But now then, what about the liquidity sweep? Well, remember here that the liquidity sweep is a slower move. The liquidity grab tends to be just one wick, while the liquidity sweep can be multiple candles. So here we actually have an example of a liquidity sweep. It's not a perfect example, far from a perfect example, but remember here, in real markets, it's very seldom you will find these perfect trades you see in textbooks. But the principle here is the same. You can see that we had a clear bounce right here. We even saw some, demand coming in. We retested this area as support 1 time, 2 time. So here is an area that many traders are likely to pay attention to. For example, traders that bought here and here might place their stop losses just below support, for example, here and here. This is a strategy that smart money traders can use, so they can push the price down, liquidate these stop losses, which leads to an even lower prices, which they can then use to push the price up. But this is a bit of a more slow process compared to the very violent grab here. But the the trading strategy is very simple here. In this case, I would probably enter the long position either here at the candle close, or I would wait for one confirmation candle, because this confirmation candle right here, you can see actually pushed above the support area. Once again, for me, the stop loss is very clearly defined. I pretty much always want to place the stop loss below the extreme of the liquidity sweep. So you can see I set the stop loss below this point right here. I leave a little bit of wiggle room, and to keep it very simple for this video, let's just use a 2-to-1 risk to reward ratio. And as you can see, this liquidity sweep, it took a few candles, but we eventually locked in some nice profit. All right, so take a close look at this chart right here. You can see that recently, every time Bitcoin has entered the New York session, we have been seeing a massive price increase. This is the power of trading sessions. And in today's video, you will learn what a trading session is, how they work, and you will also learn about the most important and the best times to trade. And by the end of this video, you will also learn how to find this indicator right here in TradingView. But right, so let's begin here by answering the very important question: what are trading sessions? Well, first of all, markets are in general open 24 hours, at least when it comes to crypto and forex. Forex is closed on weekends, but for crypto is open 24/7. Stock markets are not open 24 hours. They are only open during their trading sessions, and we will talk more about that soon. But here, what you already need to know is that the trading activity is not equal all the time. And these trading sessions follow the major financial hubs, or in other words, the major financial markets like London, New York, and Tokyo. And when it comes to trading sessions, each session usually have a different personality. Some sessions are more calm, while some sessions are more volatile, and some sessions are in general more trending. So your ability and knowing the best times to trade can help you focus on when the markets are most active, and as a result, improve your trading. But alright, so now let's take a look at the major sessions and during what time these sessions are. So these right here are the most important session times. And to keep it consistent, I know that you guys are from all over the world, so we all have different time zones. But to keep it consistent, I will use UTC for all the time. So if you want to know the current time of UTC, you can simply, Google UTC time now. But let's take a look at the major sessions. So first of all, we have the Asian session, also known as the Tokyo session. And this session goes from 0 UTC to 9 UTC. Then we have the London session. This is basically my session, or I'm 1 hour away from London. And this session is from 7 to 16 UTC. The next major session, this is basically the largest session in the world. That is the New York session. And this one goes from 13 to 22 UTC. Last but not least, we have the Sydney or Pacific session that goes from 21 to 6 UTC. And this one overlaps with Asia. And as I mentioned, you can use the UTC time to stay consistent no matter where in the world you are. And here, and this is actually very important, some sessions overlap. And when this happens, when we have multiple sessions at the same time, this can increase both liquidity, but also volatility. So for example, from 8 to 9 UTC, or I actually think it's all the way from 7 to 9 UTC, so it might be an error here, Tokyo and London overlaps, because remember, we have the Tokyo session here from 0 to 9 UTC, the London session from 7 to 16 UTC. So we do have an overlap, and this will basically increase trading activity. But here, even more importantly, you can see that we have an overlap of London, which is one of the largest sessions, and New York, which is the most significant session. So this right here is a very active period and very important period. And if we jump back here into TradingView, you can see that we do indeed, for example, recently here in Bitcoin, we saw a massive increase in volatility during this session. Today, here we didn't really see that, a little bit increase. But once again here, 3 days ago, we also saw a big increase in volatility. So this overlap can definitely be worth paying extra attention to. Yet another overlap worth paying attention to is the Sydney plus Tokyo overlap. This one goes from around 23 to 6 UTC. And during this time, you can watch, for example, some important forex pairs like AUD GPY and NZD GPY. But alright, so now let's take a closer look at the different sessions. And let's begin here with the Asian session that is, as I said, from midnight to 9 UTC. And these sessions can, of course, differ a lot from session to session. But what are some general things we can say about the sessions? Well, when it comes to the Asia session, we usually see a more calmer and range-bound market. So this can make it a little bit better for both beginners and technical traders. So during this session, if you trade forex, you can focus on things like JPY, AUD, and NCD pairs, and you can also, if you are more on the fundamental sides and trade news, you can of course trade Asian economic news. Also, during this time, crypto can move a little bit unpredictably because during this time we have lower liquidity in the market. Liquidity is a very, very important concept to understand, and luckily I do have a video about that, and I will make sure to link my liquidity video both up in the video card and the description. I highly, highly recommend that you check that one out. Last but not least, many traders use this session to basically plan for the next session, the London Open. All right, so this is a good segue to the London session. This session goes from around 7 to 16 UTC, and this is one of the highest liquidity session with strong trends, especially in forex. So when it comes to the London session, you can, of course, look out for the euro, the pound, and CHF. These are some great pairs to trade. By the way, guys, if you want to learn more about forex trading in general, I do have a video about that as well. So make sure to link that video up in the corner. In this session, you can use it for breakout and trend strategies, but you also need to be, a bit cautious of fake outs, especially during the first hour. All right, so last but definitely not least, we do have the New York session. This is the most violent session, especially when we see the peak activity here when London and New York session overlaps. So when it comes to the New York session, especially lately, the market news can create massive movements in the markets, whether you're trading crypto, forex, or stocks. News about things like, especially recently, news around the trade, basically the trade war between US and China can create massive volatility spikes. You also have news about interest rates and so on that can both create massive opportunities to make money, but if you're not careful, they can be, very risky times as well. This session is basically great for USD pairs, US stocks and crypto. It's a very, action-filled session. But here after 16, when London closes, the volatility tends to drop a bit. But all right, so now let's jump into TradingView, because now I want to show you guys an indicator that you can use to automatically display the trading sessions on the screen. So to open up this indicator, you basically want to go up here to the indicators tab in TradingView, and you simply want to search for trading sessions. And I do think that this indicator is available for, on the free version, but I'm not really sure. I personally do have a TradingView Premium, so of course all indicators are available for me. But if this indicator doesn't work for you guys, don't worry, because I do have a special TradingView link. I will make sure to put the link both in the description and the pinned comment. And you can use that link to try out TradingView Premium, so you can use everything in Premium for 30 days. And if you later on decide that you want to upgrade, you can get $15 in bonus. And at the same time, you support the channel with that link. So, don't hesitate to use it if you want to get everything TradingView has to offer. But now, as you can see, when we do have the indicator open, you can clearly see the most important sessions. You can see here recently, the New York session. Every time we have entered the New York session, we have been seeing massive moves in Bitcoin. What you also can see, and what we talked about earlier in this video, is that during the Asia session, right, also known as the Tokyo session, we usually have less volatility. You can see the action is not as big. And last but not least, yet another thing we talked about in this video is that during these overlaps between the London and New York session, we can usually see, big volatility spikes. So what I usually recommend here is, of course, to not, trade only based on the trading session. You should not, have a strategy that says, buy every time we enter the New York session or something similar. But what you can do is, depending on what strategy you're using, let's say you are, a breakout trader, maybe you, by backtesting, you can find out that your breakout trades maybe works better during the overlap between New York and London. Or maybe you realize that the breakout trades work better after, the London session closes, and so on and so on. Trading and technical analysis is much about testing your strategies. And trading sessions is basically an additional tool you can use to potentially improve your strategies, and as a result, make more money. And also, guys, last but not least, I do have just a few more things I want to go over, but this video is getting a bit too long, so I think I will wrap up right here. But as always, I will make sure to post this full presentation for our YouTube channel members. If you didn't know, we have an amazing channel member community right here on YouTube, where you will get access to lots of presentations like this. You will get access to material, more advanced material that we don't, that I think most viewers are not really interested on YouTube. So I save more advanced strategies for channel members. You also have some exclusive tools. You will get some exclusive videos, and so on and so on. And of course, you will at the same time support my work. So if that sounds interesting, please consider joining the channel membership by clicking join down below. In this video, guys, we're gonna take a look at momentum trading for beginners, or in other words, how to trade strong price moves. And one very big reason why I think many of you guys will find value in this video is because, especially, beginner traders tend to focus on, if this right here is the price, tend to focus on buying at the absolute low and selling at the absolute high. But what we do in momentum trading is that we trade in the same direction as the strength. And this can, in many cases, actually be much more simple. But all right then, so let's begin here by answering the very important question: what is momentum trading in the first place? Well, momentum trading is a trading strategy of buying and selling assets. This can be, it can be, for example, cryptocurrency if you're trading crypto, but it can also be, stocks. It can be forex, even gold, and so on and so on. But the important thing here is that we are buying and selling assets based on strong price movements. So as I mentioned, unlike buying low and selling high, which is the most common, way to think about trading, momentum traders often buy high and sell even higher. I really like this way of thinking about it. Buy high, sell higher. And we're basically capitalizing, or we are gaining on the idea that assets already moving upward will usually continue rising. And this is where the word momentum comes from. Something that is already moving tends to continue moving. So the underlying sort of concept here, as I pretty much mentioned, is that an asset in motion tends to stay in motion until something changes. So when prices basically have a force behind them, such as, lots of buyers driving up a stock, that momentum can persist for a period of time. And this is where we, as momentum traders, make money. But all right, so now then, you might of course be curious, why does momentum trading work? Well, momentum trading revolves around buying strength and selling weakness. You can of course also, bet against the direction of the market, or in other words, go short. And then it's all about, shorting weakness. So it's the opposite, but you get the point. And this basically means a momentum trader will buy an asset only after its price shows upward strength, or when it comes to shorting, shows downward strength. And there are a few important tools and concepts we need to know about as momentum traders. And the first concept here is volume and liquidity. And in simple terms, high trading volume, and we will look at this later on in this video, but high trading volume, we can think about it that it confirms that a price move is sort of real and not just a fluke. Or in other words, you can think about it as this. When we have a move towards the upside and this move is supported by lots of volume, it basically means that this volume is more significant. We can think about it that more buyers agrees that this is a valid move. And by the way, we don't really have time to dive super deep into liquidity in this video, but luckily I do have a video where I go deep into liquidity and also concepts like liquidity sweeps and liquidity grabs, and I highly recommend to check that video out to learn more about liquidity. Another very important concept we as momentum traders need to know about is volatility. And here, momentum strategies basically thrive on volatile markets where prices changes rapidly because these kind of big volatility swings create profit opportunities. And once again, if you want to learn more about volatility, I do have a video about that. I highly recommend to check out that video when you got time. Last but not least, another thing I want to talk about here is confirmation. So good momentum traders look for multiple indicators, or it doesn't have to be indicators. It can also be more general concepts here. You actually don't even have to use indicators to trade momentum. I will actually show you guys some other price action methods. This is when we only study the price, and I also highly recommend to learn about market structure. But we look at multiple concepts or indicators basically confirming the trend or confirming the price movement. But all right, so who is momentum trading for? Well, if you are a trader who enjoy quick decisions and fast moving markets, so maybe you are trading crypto, or maybe you are trading fast moving stocks, for example, tech stocks, there often is a sort of psychological rush in riding the wave. It feels really good to buy high and sell even higher. And momentum trading can be really profitable. However, what I do want to mention already, momentum trading comes with a higher risk because momentum can, if we are not careful, momentum can actually reverse quickly. So when we are riding a very strong wave, if this wave actually starts to reverse, it can reverse quickly. And this is why understanding the strategy is very important. So now let's take a look at some momentum trading strategies step by step. But all right, so now then, what are the best momentum trading strategies? Well, the first thing I do want to mention here is that momentum trading is largely technical, meaning that we use technical analysis when it comes to momentum trading. However, some momentum traders are more focused on the, I would say, the fundamental side. So there are, for example, some traders that are trading news and are riding the momentum of the news, and some traders are trading macroeconomic factors and so on and so on. But this video we will focus on technical analysis, and this is basically when we study price charts and we study the psychology behind the price movements. And now the first momentum trading strategy, and this is something, in my opinion, every single momentum trader has to learn, and that is price action. And in this video, we don't really have time to dive super deep into price action, but I will show you guys one strategy that is very important. And that is being able to identify what I call momentum candles. And we will very soon take a look at how to identify momentum candles. In simple terms, it's basically a candle with a body at least twice the size of the previous candles, and this signals strong momentum. But before we dive into that, I do already want to mention that if you want to become a great momentum trading, I highly recommend to check out my full price action trading course right here on YouTube, because in these sort of shorter videos we don't have time to go into detail into everything you need to know. So after you have watched this video, I highly recommend to check out my price action course. And also, before we take a look at the momentum candles here, I do want to just mention that we have some other important things as well that you need to learn. The second one here is breakout trading. The third one is indicators. So we can use indicators like the RSI and the MACD to actually help us understand momentum. You can use purely price action to trade momentum, but especially for beginners, indicators like the MACD and RSI can really help out. And I also want to mention here, I forgot to say it, but definitely include volume into this as well. And I do have trading courses on all of these three indicators. So if you have the time, I highly recommend to go through all my trading courses on RSI, MACD, and volume. You definitely don't have to use all of them, but at least understanding and see which one works best for you, very highly recommended. Last but not least, this I already mentioned real quick here, some momentum traders also trade based on news and fundamentals, right? And now, one key to success here as a momentum trader is to combine multiple variables or combine multiple approaches to sort of increase the likelihood of successful momentum trading. So now guys, let's jump into the chart and take a look at a momentum trading example. But all right, so now we are in TradingView. We are right now looking at a gold chart actually on the daily time frame. So every candlestick here represents one day. And by the way, guys, if you for some reason don't have TradingView yet, I do have a special TradingView link that you can use to try out TradingView Premium for free for 30 days. And you will also get a $15 bonus. So if you for some reason don't have TradingView yet, make sure to use that link so you can use all the features here in TradingView. But now let's take a look at the trading strategy. And remember, the first concept we need to understand here, and that I talked about, is something called momentum candles, right? And remember that we said that a momentum candle is a candlestick that is at least 2 times as large as the previous candles. And I usually look back at around 5 candles for this. And I usually want to actually see that the candle is even larger than 2 times as large. Preferably, I want to see something like 3 times or even 4 times as large. So let's take a look at an example so this is clear. For example, if you take a look at this candle right here, if you look at the size of the real body, that is the wide part of the candle, you can see that this length here of the real body is clearly more than twice the size of all of these previous 5 candles, right? Even this candle that was quite big, we can see that this one is clearly more than twice the size. It's even 3 times as large. So this candle right here is a great example of a momentum candle. And to understand this concept a bit more, we can also, for example, look at this candle right here. And this one is not as clear. You can see that this real body is around this length right here. And if we look back at the previous 5 candles, so 1, 2, 3, 4, 5, we can see that this candle, yes, I would consider this like a small momentum candle because it is more than twice the size of this candle, but it's far from as good as this momentum candle. So the first step for this strategy is to identify a momentum candle right here. But remember what we talked about earlier in this video. In order to increase the likelihood of a successful trade, we actually want to combine multiple factors. And in this particular case, we can actually see something very interesting because we did have, prior to this momentum candle, we actually saw a long sort of consolidating structure. You can see we printed one high, lower high, lower high. We printed, a low right here, lower low, lower low. So in a larger time frame, oops, that was a bit ugly, but we can actually see that this is almost like a sort of massive bear flag looking structure. And with this momentum candle coming in right here, that we have already confirmed is a momentum candle, we actually saw the breakout of this structure. So here we are breaking a short pattern, and at the same time we are having a momentum candle. And yet another factor we can actually consider, let's actually consider the volume. Remember, I talked about this earlier, that volume is another sort of indicator we can use here for confirmation. The more volume we have when we see a move, so for example, the more volume we have when we see a move towards the upside, the more market participants are sort of agreeing that this is a valid move. And very interestingly, we can see right here that when we saw the breakout, we actually saw a sharp increase in volume as well. So here we had 3 bullish factors happening at the same time. So if we enter our long position at the candle close of the momentum candle, setting the stop loss just below the low prior to the breakout, and with a simple 2-to-1 risk to reward ratio, the trade would have looked something like this. But right, so now let's take a look at what actually creates, or in other words, what actually drives the momentum that we as momentum traders are riding. Well, one thing that can drive momentum is news-based momentum. So things like earnings releases, product announcements, or maybe analyst upgrades can all trigger strong price movements. But as technical traders, we don't really have to, if we don't want to, we don't have to pay attention to the news. We can focus on the price, because in one sense, you can think about it that the news are sort of reflected in the price, right? But there are definitely traders that are combining analysis of news and technical analysis. Another thing that can drive momentum is sector and thematic momentum, and we also have different fundamental triggers. But right, so here, and this is very important, what about the risk management when it comes to trading momentum? Remember, momentum can be a great way to make money, but if you are not careful and if you are not respecting the risk management, it can actually lead to big losses. So this is very important to pay attention to. As I said, momentum trading can be thrilling, and that's exactly why you need strong risk control. The main things here you need to do is, first of all, to always use a stop loss and basically decide on an exit plan before you enter a trade. You need to consider position sizing. A good rule of thumb here is to risk only 1-2% of your total capital. And a third rule to have in mind here is to avoid FOMO, or in other words, fear of missing out. And for this part, I actually highly recommend to check out this video right here. This video is my full video on risk management. So whenever you have the time, make sure to check that one out. And also, guys, for all our channel members here on YouTube, I do have a special risk management tool. This one is available for all gold and diamond members. So if you want to, join the community, get exclusive videos, exclusive tools, and so on, don't hesitate to become a channel member. We would all love to have you there. Last but not least, guys, before we wrap this up, here are some best practices. First of all, you need to have good tools. So for example, if you have been following the channel, you know that I love TradingView, and I do, as I said before, I do have a special link to TradingView, so make sure to use that one out if you for some reason haven't gotten started with TradingView yet. Another best practice that I haven't really talked about too much is to keep a trading journal. Logging your trades, your entry, exit, and also reasoning behind the moves can be a very good best practice. Another key idea here is to focus on high probability setups. One very important concept to understand is something called expected value. And I do have a dedicated video to expected value for all channel members. So if you decide to become a member, definitely check that one out. And you can also consider here the best times to trade. Many times, for example, the market open can offer better volatility and also more opportunities. But this, can both increase the risk and the reward. Why did this order block work perfectly while this order block and this order block completely failed? Well, in this video, guys, we are finally taking a look at order blocks. This is something many of you guys have been asking about. And in today's video, I will answer all the common questions, like, for example, what is an order block in the first place? What is the difference between, order blocks and supply and demand? What is the difference between order blocks and support and resistance? And we will also take a look at an order block trading strategy step by step. But alright, so before we can start identifying and trading order blocks, we of course, first of all, need to know what an order block is in the first place. And order blocks are basically specific areas on the chart, and in this video I will show you guys exactly how to identify them. But this is basically areas where large market participants, think about market participants like banks, hedge funds, or other institutional traders, have placed significant buy or sell orders. Or in other words, these are essentially the footprints of the smart money. So these are areas that are showing where the biggest and most influential traders have been active. And us retail traders like me and you can hopefully use the knowledge about the smart money to actually trade in the same direction, and as a result, make money. But now then, what are the key concepts you need to know about when it comes to order blocks? Well, the first concept you need to know about is high liquidity zones. And what do I mean by this? Well, order blocks creates areas with high trading volume and liquidity. And this can then, in the future, these order blocks can act in a similar way as support and resistance levels. And by the way, guys, if you don't know what liquidity is, I highly recommend to check out this video right here. In that video, I go over both liquidity and also some important concepts called liquidity grabs and liquidity sweeps. And these concepts can be very useful if you want to trade order blocks. The next key concept here is institutional footprints, because order blocks basically reveal where large institutions have placed significant orders, giving retail traders like me and you insights into the smart money movements. This is very key. Last but not least, price reaction. And this is a concept that you need to have in mind throughout the rest of the video. And this is that when the price returns to an order block zone, it can often react strongly, meaning bouncing or stalling due to the concentration of orders there. Alright, so now when you know the very basics of order blocks, now you are ready to start learning about how to identify the order blocks. And first, let's take a look at these three concepts, and we will very soon move over to a real chart. But first of all, we need to learn about this. First, consolidation and impulse. And what we want to look out for is basically a period where the price was in a sideways range. Usually before the big move we're looking out for, we want the price to go sideways and tight. So first a sideways range, and then followed by a sudden significant move up or down. This is the two main things we're looking out for. And the last candles of the consolidation often define the order block zone. I will show you guys step by step how we can actually define the zones here. Another very key thing to look out for is volume spikes, because if we think that smart money, or in other words banks and the big boys, have actually traded on a zone and created an order block, we need to see evidence of trading volume. So if this is a real order block, we want to see high volume on that zone. As you can see, order block areas tend to have high volume activity as the institutions execute their large trades. Last but not least, this one is not as important, but multiple touches is something to have in mind. So previous price reactions at a level can actually help us signal an order block. If the price reversed sharply at a certain price region before, that area could actually be an order block. It can indicate that this is an area where the smart money are placing orders. But alright, so now let's take a look at the order block trading strategy step by step. And right now we are in TradingView. By the way, if you for some reason haven't gotten started with TradingView yet, I do have a special link. That link is both in the top comment and the description, and you can use that to get a free TradingView Premium for 30 days and $15. But all right, so let's begin here with how to identify the order block. And here, the first thing to look out for and the easiest way to spot them, at least in my personal opinion, is to look out for these massive candles, like for example, right here. This right here is what I call a momentum candle. A momentum candle is basically a candlestick that is at least 2 times as large as the cluster of the previous candles, but preferably I want this candle to be maybe 3 times or even 4 times as large as the previous candles. So the first thing I look out for is a strong momentum candle. But also remember here, let me actually go here to geometric shapes. This is a tool I'm using a lot, the rectangle tool right here. Also remember that in order to have a valid order block, we want to look out for an area of consolidation here, at least preferably before we see this strong candle. Because this is actually the area we will later on use to find entry levels. Like for example, right here, you can see the beautiful entry level we saw right here. And after that, you can see that the price actually exploded here to the upside. But now, and this is very important, and this is also a question I have been getting a lot, and that is, how exactly do we draw these areas? Because these areas are very important. And the answer here is, the truth about this is that many traders have slightly different variations on how to exactly draw these areas. But as a general rule of thumb, you want to try to include the consolidation area. You can, to just have if you want a mechanical rule, you can choose a certain amount of candles. Like for example, you can choose that you include 5 candles, so 1, 2, 3, 4, 5, and you include the whole bodies of all of these 5 candles. So after you have drawn out your order block and after you have identified this momentum candle, the next thing you do want to do, remember from earlier in the course, is that we need to look at the volume, because if smart money is really stepping in at this level, we should see a spike in volume. So let's actually analyze the volume right here. We can see that the move was right here. And if you go down here to the volume, you can see just as what we predicted, we saw a massive increase in volume. So this right here is a good sign. When you have followed all these 3 steps, you have your order block, you have the momentum candle, you have the volume, then we are all set. The next step here is a waiting game. So you can see the price goes up, but then eventually the price came back down, and you can see it came back down and then we touched the zone. This right here is our opportunity to actually enter. Some traders enter at the order block, some traders wait for the confirmation. So some traders would enter right here. Some traders would try to, maybe have limit orders, right? Maybe have limit orders at the order block. By the way, if you want to learn more about the different order types, I do have a video about that, and I will make sure to link it up in the corner and the description. I do highly recommend to watch that one. But here, another thing you can use to improve your order block trading strategy even further is to use price action. And price action is basically the study of how price moves, and included in price action we have things like candlestick patterns, we have things like how prices reacts to certain levels, like for example how the price reacts to order block. And if you look closely right here, you can actually, if you look at these 2 candles, we can actually see that this is what we call a BE, or in other words, a bullish engulfing pattern. This is a bullish Japanese candlestick pattern indicating a move here towards the upside. So here we actually had yet another bullish sign indicating a move upwards. So after we have seen all of these bullish signs at the same time, we're ready to actually buy, we're ready to use our long position. if we enter here at the candle close of the bullish engulfing, when it comes to stop loss, some traders set the stop just below the order block or just below the pattern. In this case, I would actually set the stop loss just below the pattern because it was a massive pattern. And then using a risk to reward of 2, our trade would have looked something like this, and we would have locked in some nice profit. So what exactly is an order book, and how are professional traders using it to predict price movements? And even more importantly, how can you use these special TradingView indicators to look out for the same signals the pros are seeing? That's exactly what we're going to talk about in today's video. But alright, so the very first thing we need to take a look at is, of course, what is an order book in the first place? Well, in simple terms, an order book basically show you all the current buy and sell orders for a specific market. For example, Bitcoin traded in US dollars, or the Apple market, and so on and so on. And another word for buy orders is bids, and another word for sell orders here are asks. And together, the highest bid and lowest ask form something called the bid-ask spread. And a simple way to think about the order book is basically like a live map of the supply and demand of the market. So if this sounds a little bit complicated right now, I think that this visualization will help clear things out. So this right here is a static example of an order book. We have the buy orders, or in other words, the bids here to the left, and we have the sell orders, or in other words, the asks to the right. And in the order book, you can see the price, and you can see the quantity, and then you can see the total amount. So for example, for the buy orders, the price is what are the buyers willing to buy for. The quantity is how much in total are the buyers willing to buy. And the total here is just the price times the quantity. And the same thing is true here with the sell side, or in other words, the ask side. And the spread here is simply the difference between the highest buy order, which is 39,998, and the lowest sell order, which is right now 40,002. So the current spread is currently $4 for this particular market. But what happens in real markets is that these orders will move all the time. Live markets are, by definition, live. So it can get a little bit more complicated. So as a simple example, let's take a look at the live market of Bitcoin. Right now, I'm in Bybit. And by the way, if you guys want to trade crypto and want to be able to make money when the price goes up, but also when the price goes down, I do have a special link to Bybit, and I will make sure to have that link both in the top comment and the description as well. And by using that link, you will get more free bonuses the more you trade. And the max amount is actually $30,000. However, most traders will not get all the way there. But if you want to trade crypto, definitely check that one out. But here on the screen, what you can see is, first of all, right here is the order book. You can see this block right here. This whole block is the order book. And here you can see the live orders. So the lowest sell orders or ask prices are down here. And the lowest buy orders or bids are right here. And the spread is the difference between the lowest sell and highest buy. But what you can also see right here, and this is actually a very useful tool, this right here is what is known as the depth of market. And if you are in Bybit and want to get to this one, the standard view will look like this. This is just a candlestick chart, and you can find the depth of market right here. And now you might wonder, what are the depth of market? Well, here, when you scroll in the depth of market, you can see different price levels, and you can also see how many buy and sell orders that are on these different levels. So hopefully you can see that on some parts, you know, the market is moving very fast right now, so it's hard to even explain this. But you will often see that on some levels, you can see that we have many more orders. You can see it almost looks like a star. And these levels can be extra significant levels if we have these sort of large orders at certain levels. We will later on in this video take a look at more closely how we can use the depth of market and other indicators as trading strategies. But for now, all you need to know is that these kind of depth of market tools can be very useful. I can actually try, let's actually open up a much lower, slower market so we can look at this more clearly. So let's filter on volume here, and let's choose a market with very little volume. You can see it is even a risk alert right here. But here in this market, you can see that it's much slower. It's pretty much static right now. And you can see that you have certain levels where you have extra many buy orders. For example, right here, you can see we have a large buy order. And here you can basically see all the buy orders in the market. And at the same time, you can see all the sell orders. But all right, so now then, how does the order book work? Well, first of all, we need to understand the different kinds of orders here. First of all, we have the limit orders, and these are the orders that you can see and that sits in the actual order book. But you also have something called market orders. A market order is basically an order which executes directly when you use the order. And by the way, guys, if you want to learn more about order types, I do have a full video about that, and I will make sure to link the video up in the video card and the description. Highly recommend to check out that video. You pretty much need to know about orders in order to use the order book effectively. But here, when a trade happens, the order book updates in real time, and this I have already showed you guys. And another thing, big market orders here can sort of sweep the book. So if you have enough capitals, you can sweep many orders at the same time, and that is an important concept to have in mind. And here are some very important concepts to have in mind. First of all, market depth. We already talked about the market depth here, and that is the volume of orders at each price levels. The more depth, the more liquidity. We also have the order size. This is simply the quantity someone wants to buy or sell at a specific price. Another concept here is the concept of buy and sell walls. And these are basically large clusters of orders at a single price level. And these can act as support and resistance. We also have the bid-ask spread. We have touched upon the bid-ask spread shortly in this video, but if you want to dive deeper into the bid-ask spread and why it's so important, I do have a video about that, and I will make sure to link the video in the video card and the description. All right, so now let's take a look at the order books in different kinds of markets. So are you trading crypto? Are you trading stocks, forex, or maybe something else? This is important for you. So first of all, stocks use a centralized order book, like for example, you might have heard of the Nasdaq, or if you are not from the US, you probably have many different exchanges in your own country. And for stock markets, it's basically the exchanges that has these order books, and traders can see level 2 data for deep market insights. And here, when it comes to crypto, it's actually each exchange that has its own order book. So remember earlier when we talked about Bybit, the order book we saw was only the order book for Bybit. So for example, Binance will have another order book, Coinbase will have another order book, and so on and so on. So this can make it maybe a bit less significant, but the exchanges tend to follow each other pretty closely. So you can definitely still use order books when you trade crypto. However, when it comes to forex, we have no central order book. So some brokers show sort of partial order book or liquidity feed, but it's much less transparent. So I would say that stock market is the most transparent one, then crypto, then forex. Right, so now let's jump into TradingView, because now I want to show you guys the best indicators for order book trading, at least in my personal opinion. So the first indicator I want to show you guys is actually not really an indicator. You know, you usually find the indicators here in the indicators tab. But here I want to go to, you see where it says candles. Right now we're looking at a normal candlestick chart. But what you do want to do is that you want to go down and click on volume footprint right here. And as you can see, after you click on this one, the whole appearance of the chart will change, and your chart should look something like this. And by the way, I think that right now the volume footprint is only available for TradingView Premium, but luckily I do have a special link to TradingView that you can use to get free 30 days of TradingView Premium, and you will also get a $15 bonus from that link. So make sure to use that link if you haven't already, so you can follow along with this indicator. But in simple terms, what the volume footprint chart basically show you is historical volume at certain level. So how you can think about this is basically that this is historical order books that you can see on the chart. So you can basically see how the orders have been flowing in the past, and we can, as traders, use this information to potentially predict how the prices will move here in the future. And unfortunately, in this video, I don't really have time to go too much in depth for this indicator. But what I can show you right away is a settings I tend to use. So you right click right here, you go down to settings, and then if you go to, as you can see right here, it says volume footprint. And what I like to do is to change the type here from buy and sell and choose delta right here. So I choose delta and then I go down and press OK. Because now instead of having both the buy and sell side, now we will simply see the buy volume minus the sell volume. So when we have green bars, this means that we had more buy volume than sell volume at that particular level. And when we have red bars, that means that we had more sell volume than buy volume at that particular level. But as I said, guys, if you want to learn more about the volume footprint chart, I do have a video about that, and I will make sure to link the video both in the video card and the description. But now, many of you guys might already know about the volume footprint, so you might be curious what are some other indicators that we can use here. And another indicator we can actually use, now you want to go up to the indicators tab in TradingView, and then you want to search for, once again, volume, but now you want to search for volume profile. So here you have a few different volume profiles to choose between, and you also have tons of volume volume profiles created by the community. But for now, we can use just the visible range volume profile. This indicator is a bit different than the volume footprint because now we will show, you know, how much volume have been traded at certain levels. So this is not so if you, for example, look at the bar right here, this indicates how much sell and how much buy volume that have been traded at this particular horizontal level, right? And because we are using the visible range, you will see that when you change the range of TradingView, the volume profile should change. So as you can see, we zoomed out a bit and the volume profile will change. And for this indicator, once again, we don't have time to go over every indicator, but I'm definitely interested in making a video, a specific video about the volume profile in the future. So let me know down in the comments if you want to see a video on that. Last but definitely not least, I can show you guys one more indicator. This one is called the CVD. You can see here, once again, we have tons of different indicators, but you can simply open up this one right here. And this one is pretty similar to the volume footprint chart, because what the CVD basically tracks, it tracks the buy volume minus the sell volume. So a rising CVD means that the buyers are dominant or that the buyers are in control, and a falling CVD means that the sellers are dominant, or in other words, in control. And this right here is yet another indicator that I do want to dive even deeper into. But right, guys, so this video is getting pretty long, so I do think I will wrap up right here, but I will make sure to release this whole presentation to our YouTube channel members. All gold members and all diamond members will get access to this presentation. I do have some both some beginner friendly order book trading strategies and some more intermediate trading strategies, like for example spoofing and much more, that I haven't had the time to talk about yet. But all gold and diamond members will get access to this. So if you want to get access to this presentation and support the channel, please consider becoming a channel member by clicking join down below. So if you want to make money trading, and I'm not talking about winning a trade here, losing a trade there, I'm talking about being consistently profitable. If you want to do that, you need to learn risk management. So in this video, you will learn risk management for trading stocks, forex, and crypto. We'll take a look at the most important concepts, the tools you need to use, and I will even show you guys a special tool we have here in our YouTube community that you can use to calculate important things like expected value that we will talk about, but also things like position sizes, risk reward, and more. But alright, so let's begin here by answering the very important question: what is risk management? Well, risk management is basically the practice of protecting your trading capital. This is basically just a fancy term for saying protecting your money. And we basically do that by controlling our losses, controlling our potential losses we have on each trade. And this helps us survive bad trades and, stay in the game for the good trades. I would say that a lack of risk management is the by far most common beginner mistake. So I already want you guys to have this in mind. If you trade without risk management, this is basically like gambling. This is basically like going to the casino, as you can see right here, like betting in the casino. So you need to learn risk management, so make sure to really pay attention throughout this whole video. But now, what are the most important risk management building blocks? Well, the first one you might have heard about, and that is stop loss orders. A stop loss is basically a predefined exit or a predefined level on the chart that limits your loss on a trade if the market goes against you. So let's say that you buy at 100 right here and you set a stop loss at 90. If the price goes down to 90, you will automatically sell. Then we have something called a risk to reward ratio, and this is basically a ratio comparing your potential loss with potential gain. So for example, a 1 to 3 risk to reward means that you are risking $1 for every $3 you are making. And don't worry, we will talk more about risk to reward soon. Another very important thing here is position sizing, and we will take a look at this calculator later on in the video, which you can use to actually calculate position size. And for now, this calculator is available for channel members. All MindMath Gold and MindMath Diamond members have access to this calculator, and we will take a closer look at this calculator later on. But it can be very useful for calculating the position sizing. And last but not least here, another very important risk management concept is the 1 to 2% rule. And this is that you never want to risk more than 1 to 2% of your trading account. And this is also, as you can see right here, this is a part of the position calculator as well. But now let's move on to some very common risk management beginner mistake. And the first mistake here is basically the belief that trading is a very quick path to riches, and this leads to risking too much, and this is often the path to losing a lot. I think we have a quote, something along the lines that trying to get rich quick is the quickest way to get poor quick. It's not exactly like that. I misremember the exact quote, but I think you get the point here. Another very common beginner mistake here is not using stop losses, or basically moving the stop losses away when you trade. You need to respect your stop loss. Another super important mistake here is over leveraging with borrowed money, or in other words, using too much leverage. And when it comes to leverage, we don't really have time to dive deep in this video, but I actually do have a full video where I go over everything you need to know about leverage, and I highly recommend to check that video out after this video. Last but not least, this is another very common mistake, is the what I call it will come back mentality. And that is basically that you hold on to a losing position for way too long. Perhaps you move down your stop loss, the price continues to go down, you move down your stop loss even more, and you think, the price will eventually come back. This is a very dangerous mentality. But alright, so now let's actually take a closer look at the risk to reward ratio. This is one of the most important concepts to understand when it comes to risk management. And the risk to reward ratio basically compares what you could lose to what you could gain on a trade. So it basically helps you determine if a trade is worth taking or not. And here, many trading strategies use a risk to reward ratio where the reward is at least 2 to 3 times the risk. So it's very common to hear that we have a 2 to 1 risk to reward or a 3 to 1 risk to reward, meaning that we win at least twice to 3 times as much as we lose. So here, if we scroll down, we have some examples of risk to reward ratios. But I think it's easier to just use a calculator. And by the way, if you want access to this calculator and also the expected value calculator and more stuff in our YouTube community, please don't hesitate to become a channel member today. We would love to have you in the community, and you will also get access to tools like this one. But let's go to the risk to reward ratio here and take a look at some examples of risk to reward. So let's make a very simple example. Let's say that we enter a stock or cryptocurrency at $100. We set our stop loss at, let's say, $90, and we have our take profit at, let's say, $110. Here with the calculator, you can also choose your win rate. So let's say you have backtested and have a win rate of 60%, and then we can calculate the risk to reward right here. So first of all, you can see here that here, because we risk $10 and we can win $10, we have a 1-to-1 risk to reward. But very importantly here, because we have a 60% win rate, you can actually see that we have a positive expected value. And this is something we will talk about later on. You also get this notification here that the risk to reward ratio is low, and it's recommended a minimum of 1 to 2 risk to reward. So let's actually choose a 1 to 2 risk to reward, which will be if we have a take profit at 120, right? Because if we have a take profit at 110.20, let's calculate. As you can see, our risk to reward is now 1 to 2, and once again we have a very, very nice positive expected value. So yeah, now you have a basic understanding of risk to reward. Now I want to turn the attention to something very important. And this is basically calculating the break-even win rate. So to determine the minimum win rate we need to break even, we can use this formula right here. It's not super important to learn the formula, but I hope this can make a good sort of intuition. So if we have, first of all, if we have a 1-to-1 risk to reward ratio, so we risk one, for example, risk 100, and we can win 100. Then it's pretty clear that our break-even win rate is 50%. So if we win 100, lose 100, win 100, lose 100, we will, go even. But here, if we have a 1 to 2 risk to reward, meaning that we win 200 and lose 100, now we only need to win 33% of the time. So if we win more than 33% of the time, we will be consistently profitable. And this goes on and on. With a 1 to 3 risk to reward, we only need to win 25% to break even, and so on and so on. So I hope this gives you guys a sort of good definition about the break even win rate. But alright, so now let's actually switch the attention to position sizing. This right here is very important because this determines how much you should trade, how much capital you should use. As you can see, position sizing determines basically the number of shares or how many cryptocurrencies and so on that you should trade in order or so that potential losses stay within good limits. And a good rule for this is to use the 100% rule, or in other words, you should not risk more than 1% of your account in a single trade. This is a pretty conservative rule, but it's a good rule. And if you follow that rule, you will not, blow your account, which is a common, very common and devastating mistake that beginners make. And here, if you use our Mind Math Money community calculator, you can just go to position sizes here, and the standard, the original value here for the risk per trade is 1%. But some traders, as you can see here, the conservative value is 1%. Some traders use 2% or even 3% risk per trade here. But to make this clear, let's say that we use 1% risk per trade. And as for our account size, let's say we have an account size of $10,000. And to make this a super simple example, let's say that we enter at $100 and we have a stop loss at $99. So the stop loss is $1 down. You can also choose your market. Let's just, for example, say we choose crypto right here and make our calculation. Now, just like that, you will see first of all, how much you risk. We risk $100 because that's 1% of $10,000. You also get the risk per unit, and that is $1 because of our entry price and stop loss. Our position size is a total of 100 coins, and our position value here is actually 10,000. And here you get an automatic warning that this position uses 100% of our account, and that might not be, optimal. But right, so now I do want to talk about what, at least in my opinion, is the most important concept in risk management, and maybe the most important concept in trading in general, and that is expected value. So if you haven't heard about expected value, make sure to really pay attention. In simple terms, the expected value is the average amount we can expect to win or lose per trade if we take many trades. So this is basically a measurement that combines our win rate with average win and loss size. So when it comes to trading, just as a simple example, let's say that you have, let's say that we have a 60% win rate. This means that we also have 40% to lose. And if you have a trading opportunity with 60% win rates, and let's say that you risk 100 and you can win 100, then this is a trade you should always take, because if you take many of these trades, you will make money. But this doesn't mean that we can't be unlucky and maybe lose, 2 times in a row or even 3 times in a row. A 40% chance can happen 3 times in a row, 4 times if we are unlucky. And that is why such an important part of expected value is that we actually take many trades. So as you can see, right here is the formula for expected value. The formula is that you take the win rate times, how much you win minus the loss rate times how much you lose. So here is a simple example, but as always, I do think it's so much easier to just use our MindMathMoney calculator. So now we are back here in our MindMathMoney risk management calculator. You simply want to go here to expected value. And as a very simple example, let's say, once again, let's take the 60% win rate example. You can also use this slider here to choose whatever win rate you want, but let's choose 60% here, and let's make this super simple and say that we risk, you know, 1,000 per trade, and we can win 1,000 per trade. Now let's calculate the expected value. Just like that, you can see that our expected value, so this is what we expect to win if we take a large amount of trades, is $200. You also get some nice information here. You get the risk to reward ratio, you get the break-even rate, you also get the expected profit over 100 trades. So if we take 100 trades with this strategy, we expect to win $20,000. And by the way, guys, if there are any terms you don't understand with this risk management calculator, I have all the terms explained in very simple terms right here on the page. And I also have a, you know, members only video where I go into more detail on this risk management calculator. But alright, so now I want to talk about a super important concept, and this is to manage drawdowns. And you know, what is a drawdown? Well, a drawdown is basically the decline from the peak in your account to the lowest point. And a very important concept here is that larger percent losses require even larger gains to recover. So for example, if you have lost 10% from the peak, we actually need 11% to recover. If we have lost 20% from the peak, we need 25% to recover. And you can see that this gets worse and worse. If we have lost 50% from the peak, we need 100% to recover. And if we have lost 90%, we need 900% to recover. So this, I hope that this table just show you guys how important risk management is. And here, and this is very crucial, this is why avoiding deep drawdowns is so important. The bigger the hole, the harder it is to climb out. That is so true. And here, last but not least, these are some memorable things to have in mind after this video. First of all, you want to take care of your losses, and the profits will take care of themselves. This is one of these classic quotes which do have, you know, it does have a lot of truth to it. Another thing is you should focus on preserving capital rather than trying to make quick profits. Remember, trying to get rich quick is often a quick path to getting poor. Also here, make sure to be more defensive during drawdowns, because as you recently saw, the bigger the hole, the harder it is to climb out. The larger the drawdown, the harder it is to recover. And also, another key thing is that you can actually adapt your risk management to market volatility. So if we have more volatility, you may want to reduce, for example, your position size or risk to reward ratios. And also, last but not least, remember, you can't trade at all if you have no capital left. The market doesn't make you lose money. Your psychology does. In his book, Trading in the Zone, Mark Douglas identified the mental traps causing most traders to fail. So in this short video, I have summarized and simplified his most powerful insights to help you think like a trader to start making money. But alright, so let's begin here by taking a look at who was Mark Douglas and why does he matter? Why should you even, watch this video? Well, Mark Douglas was a trader who lost basically everything relatively early in his career. And this was not necessarily due to, bad trading strategies, but more because of his mindset. So instead of quitting trading, he spent years studying why traders fail, and specifically why traders fail emotionally, and also how to fix it. Maybe this sounds familiar to you. Perhaps you had a trading plan, you knew exactly what you were going to do, but for some reason your mind made you either take profit too early, or perhaps selling something that you didn't plan to sell. So psychology is very important. So on this topic, he wrote the book here called Trading in the Zone. This book is like an all-time classic when it comes to trading psychology. It's very popular amongst traders, and that is for a good reason. I don't agree with everything in the book, to be quite honest, but there are some very nice insights in the book too, and that's what I'm gonna focus on in this video. As I said, it's now a must, considered basically a must read on trading psychology. And his work teaches things like thinking in probabilities, controlling emotions, sticking to plans, and in short, he has helped multiple traders win more and make more money by sort of mastering their own minds and take control over their emotions. But right, so now then, what is the sort of core, what is the heart of his teachings and the heart of the book Trading in the Zone? Well, most traders focus on finding the perfect strategy, and don't get me wrong here, this is very important, because in order to win in trading, you need to first of all have a good strategy. But what Douglas discovered was something very critical, that psychology determines success more than strategy, or at least this is what Mark Douglas said. I wouldn't say that psychology is more important, but I definitely agree that it's very important. So here, me and Douglas have a little bit of a different view, but nonetheless, trading psychology is very important. So here, even the best trading systems fail when traders either 1. Let emotions drive their decisions, 2. Can't handle losses mentally. This is very important. You need to be able to handle your losses. This is also very important. The need to be right on every trade. This is something you have to stop. This is a mindset you really have to leave here. Another very key thing is lack of consistent discipline. And Douglas believed that trading is 80% psychology and 20% mechanics. As I already said, I definitely don't agree with this. It's not 80% psychology. But what I definitely do agree with is that even if you have a profitable trading strategy, if your psychology is not in check, your strategy won't matter, because you will make so many mistakes. But all right, so here are the 5 trading truths that every trader must accept. And Douglas taught that successful trading requires a probability-based mindset. And this is one of the principles that I agree with 100%. These 5 fundamental truths form the foundation. First of all, anything can happen. Even perfect setups can lose. So let's say that you have like a perfect trading strategy. Maybe this trading strategy has like a 75% win rate. That is a great win rate. But this still means that you have 25% to lose. So you have 75% to win, but you still have 25% to lose. And if you are extremely unlucky, this 25% can happen multiple times in a row. And this is something you need to accept as a trader. Anything can happen. Another very important thing is that you don't need to predict the market to make money. But what you need to do is that you need to be right most of the time. Or this is actually a simplification, because depending on what risk to reward ratio you are using, you don't even need to be right all the time. If this sounds a little bit complicated, I highly recommend to watch my video on risk management, and I will make sure to link the video up in the corner as well as in the description. The next principle, wins and losses come randomly. Even with a strong edge, this builds upon the previous principle. And here, you might of course wonder, what is an edge? Well, in simple terms, an edge is basically higher odds. It's basically when the probabilities is stacked in your favor, but it still never guarantees a win. Last but not least, every trade is unique, so treat it that way. I can also just mention super quickly here that if you want to dive deeper into what an edge is and how to build your own trading edge, because this is something you need to make money in trading, I do have a video about that. However, that video is currently only available for channel members, and it's only available for diamond members, but I just want to make that quick shout out. But right, so now you might of course wonder, how will these trading truths help you as a beginner? Well, you stop when accepting these truths, you will stop needing to be right, and you will start thinking in probabilities. This is such an important step. You will also avoid emotional traps like panic selling. You're probably familiar with that feeling. Or another very dangerous one is chasing losses, and also trying to win back what you lost. That is very dangerous. You will also build consistency, which is the #1 goal in trading. As traders, if we want to be consistently profitable, we of course, built in that name is consistency. Here, also very important, focus on the process rather than the outcome. This principle, by the way, can be applied to pretty much all things in life, in my opinion. You want to focus on what's in your control. The only thing you as a trader can control is you can control your trading strategy. You can control your psychology so that you follow your trading strategy, but you can't control if you will win or lose. At the end of the day, it will be some randomness involved. So by following these principles, you will also develop a true mental discipline for long-term success. All right, so here, and this is very important, let's dive a little bit deeper into risk acceptance. So first of all, and this is very important, you only want to risk money you are fully okay losing. And as a rule of thumb, this can be very useful. If a loss really feels painful, if you lose a trade and you're like, this really sucked, I almost can't take it. If that's a feeling you have, then you are probably having a too large position. Your position was too big. So if that happens, you need to limit your risk. And once again, I recommend checking out my video on risk management. Another key principle, you want to accept risk before the trade. So before taking the trade, you really need to accept that this trade can hit my stop loss. And if my stop loss gets hit, I'm totally okay with that because I have already accepted the risk. Another very important thing to think is that, the market is neutral. The market is not, out to get you. The market is not evil. The market is not, trying to fool you. The market is neutral, and we as traders can make money based on the market, or we can lose money. But thinking that the market is rigged will not be helpful. And this leads into taking full responsibility for your results. Don't blame external factors. Don't blame the market. Don't blame anyone else than yourself. And this is a good quote. When you truly accept the risk, you will be at peace with any outcome. But right, so now let's take a look at Mark Douglas' 7 principles of consistency. 7 principles to make you consistently profitable. The first principle, and arguably the most important one, is that you need to know what your edge is. So before you trade, you need to know your strategy, and you need to know, what is your edge? What makes me think that I can make money in the market? Is it some kind of technical analysis setup, or maybe it's some kind of fundamental analysis? It doesn't really matter, but you need to have an edge. 2, you need to define your risk before every trade. So you will need to know, how much can I lose? You can do that by setting a stop loss. And 3, you need to fully accept the risk before entering. I talked about this earlier in the video and why it's so important. 4, you should act on your edge without hesitation. So what I mean by this is that if you know that you have a setup with, let's once again use the 75% win rate example. You know that when I see this setup in the chart, I do have a 75% chance win rate. If you know this, you need to act on every single time you see the setup. You of course need to take it without hesitation. Even if maybe you have a loss streak, maybe you know with this setup you have a 25% chance or 25% risk to lose. And let's say that this has happened 3 times in a row. You were super unlucky, lost 3 times in a row, even with a 75% win rate. But as long as you know your setup is correct, you still need to take these trades without hesitating. So here, this one leads into this one, and that is that I take profits as the market makes them available. 6, I monitor myself for emotional mistakes. So if you make one of these mistakes we have been talking about in this video, you need to take one step back, and one thing you can do is to write them down, whether you have a notebook or digitally. Write down your mistakes, what happened here, what principle did I break, and so on and so on. And last but not least, stick to the rules without expectation. These rules turn discipline into a habit, and habits are what lead to consistent results. But right, okay, so I'm seeing that this video is getting pretty long, so I think I will wrap up right here. I do have some more slides that I wanted to cover, but as I said, this video is getting a bit long, so I think I will save the rest of this presentation for our channel members. If you didn't know, we have an amazing community right here on YouTube, and by joining, you will get access to things like exclusive videos. You will get access to multiple full presentations like this one when we take a look at extra material, and at the same time you also support my work. So if you want to join our family here on YouTube, that would be super awesome. And if you don't, one way to show support on these kind of videos is simply by dropping a like. All right, so congratulations, you have finished the full Smart Money Concepts trading course, but this right here is only the beginning of your trading education. To continue your trading journey, I highly recommend to check out this playlist right here. Tons of more free trading courses are waiting for you.